All right. What is up, traders? What's up, tycoon? Super excited for today's video. Exciting days in the market, right? Jerome Powell came out and as I was thinking, all right, honestly, I was thinking that the Fed meeting, the FOMC meeting, was going to become a sell the news event. I've never really seen a 99 percent chance of, basically them not cutting the rates, right? Speaking about the CME Fed Watch tool, normally it's not at a 99%, which is basically a guarantee. So at that point, to me, a little bit of the rally that we had before FOMC was them pricing that in, and then it was going to become a sell the news event, and that's definitely what we've seen. Now, yesterday was a really fun day. Went out paddleboarding and just didn't even really trade. Okay, sometimes you just got to take those breaks and enjoy the day. And so, I'm going to catch up on some content that I need to deliver to you guys. Okay, I wanted to put this out yesterday morning, but didn't just get around to it. We had the TLT 20-year bond ETF. I mentioned that I'm looking for this to establish a range. Now, we're breaking through the lower end right here. We just broke through this demand zone. And this morning, pre-market, we're actually breaking through the previous October or November lows that TLT had, which I've been kind of showing you guys that there is a path and scenario for that. But we're going to take a look at the charts and go over, what I'm really paying attention to a little bit more in the short term, and kind of talk about some long-term things as well with TLT. We're going to take a look at the S&P 500. So on this chart, again, catching up, there was a bullish divergence here. Okay, so, we were creating these lower lows while creating these higher lows on the RSI right here, and on our momentum and on our MACD. So there was lots of bullish divergence, and we did actually get a rally. But as I mentioned, it turned into a sell the news event. We'll break down some key things on the SPY. And then we're also going to take a look at the US dollar, right? This is where the US dollar was around 105. And we're going to look at it today, and it's above our price target here of 105.435. Okay, absolutely blew past that. The dollar is going to be a little bit more relevant to you as a trader right now than the VIX. The VIX is just basically pricing in kind of a soft landing. And that's why we really have seen the VIX so low, right? When you think about volatility and fear in the market and things like that, you're just not really seeing it portrayed through the VIX. And so, the US dollar index, the Dixie, has been something that I've been using a little bit more as a proxy to the stock market. Now, as always, the content provided on this channel is for informational and educational purposes only, and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. We're going to start off here talking about 31% of all U.S. government debt outstanding, or $7.6 trillion, will mature over the next year. Why is this so important? Why is this relevant to you? Well, because of how high interest rates are. So as this debt matures, they're going to be looking at higher interest rates now, and it's going to be a pretty big deal. Okay, the U.S. government is already paying $1 trillion in interest alone. So, big things to be concerned about there. When you take a look at the weekly national mortgage interest rate trends, 30-year fixed is at 7.5%, basically. So really, really rough time right here. If, taking a look at these mortgage rates, it's pretty crazy. Also, you have the annual change in U.S. consumer auto insurance prices up 19%. Now, what's crazy to me is that aren't cars getting smarter, safer, and more efficient, and somehow insurance prices are going up? I mean, shouldn't they technically be going lower in a sense, right? If cars are getting more safe and things like that. So something just kind of interesting there, and something that I just wanted to point out and give kind of my 2 cents on. Now, here's what's really important. When you take a look at crude oil, okay, and pretend you don't know this is crude oil, pretend this is your favorite stock. Does this look bullish, right? I mean, this looks like this thing is ready to break out and potentially retest the highs. And it's pretty important to the market, right? I mean, if energy sustains really high prices and oil, goes up very, very high, the likelihood of, energy potentially causing a recession or being an indicator for a coming recession increases more and more. And when you take a look at the drivers of oil prices, you have these blue lines are supply contributions, right? So you can see in the beginning of the year, a lot of it was supply contributions, right? Especially, and this is January 2022. And then you can see in July 2022, again, largely due to supply contributions, that's pretty much flipped, right? as soon as we hit summer here, July 2023, we're actually seeing that go down. Okay. And so the supply contribution is actually a negative overall, contribution change. And the demand contribution is what's really driving the price higher for oil prices right now. And this is basically telling you that, you know, uh, what you're seeing here is it's not really much of an impact, right? Or not that it's not much of an impact, but there's not really much chances of this dropping, right? We're seeing such high demand for oil, and the demand contribution is really what's driving oil prices up right now. And if that sustains, if that continues, again, we could see oil prices break out to the upside. Now, this is the year-over-year change in WTI crude prices, and then it's followed by some recessions. And essentially, what we're looking at here is you need to be really cautious of when oil prices and WTI basically doubles. Okay, if you look at 1990, September 1990, it basically doubled, went up 96% recession. Okay, and then in February of 2000, went up 142% recession afterwards. And in June of 2008, went up 97%, again, roughly 100%, and recession. So we can see the rise here. Okay, but if this keeps going at a very dramatic pace, and if we get to a point where year over year it goes up 97%, 95%, or even past 100%, then the chances are very high that we are going to have a recession. So it's not the worst if oil prices just continue to steadily rise and grind up, but if they have this accelerated pace where they basically double year over year, that's a really bad sign, and that's something we need to pay attention to when it comes to the pace of oil prices rising. Now, this is the percentage of XLE stocks advancing for 5 consecutive days, right? And you can see that's at 0%. So why am I showing you that? Well, I've been pretty bullish on energy. And, if you're a value investor, energy is a place where some of the valuations still make a little bit of sense versus, you take a look at the PE ratios, for a lot of these other big tech stocks and things like that. And people have been saying that they need to drop, right? That the stocks are overvalued. And this chart just basically shows you that these stocks are not overbought, right? I mean, something definitely can't be overbought if it hasn't advanced for 5 consecutive days. And so, again, just kind of suggesting that if energy prices, oil prices keep going higher, it's very possible that XLE, the energy sector stocks, can keep advancing higher as well. Now, this is what the newsletter looks like. If you guys don't know, I started a completely free newsletter. About a month ago, we were talking about energy and highlighting ExxonMobil. Okay, and this was the chart. That's what it looked like here. We were talking about, some targets up here around 119. Well, you can see that it actually rejected that level right there and actually started to form we put a nice little trend line there, broken through that trend line, and from the 111 original price, ExxonMobil went up to 117, right? And we're going to see if it can advance higher up to 119. Now, I don't talk about just energy. This was also a Tesla trade in here that we gave out about 2-3 weeks ago. Okay, going over the abandoned baby chart pattern as well as the trend line and some key levels. Again, there's a link in the description. You can sign up for this newsletter. It's called Investment Intelligence. And if you trade options, that Tesla trade was a very, very profitable trade, up hundreds of percent on, call options, basically. So if you want to sign up for that, right, get free trade ideas as well as free valuable content straight to your inbox, definitely use the link in the description or the comment section. Sign up for that. It's a great way to get yourself some alpha, get yourself some really good information while also supporting the channel. I do want to mention that I also do one-on-one sessions. Okay, so you can come over here to the Ko-Fi platform. There's a link in the description for that. You can click on the commissions page and you guys can book a session with me. All right, we do 30-minute sessions, 1-hour sessions. There is also a tab on there where you guys can request a specific YouTube video. If there's some type of content you guys would like me to make, analyze a certain stock, analyze a certain sector, or go over strategy or tutorial, feel free to do that on the Ko-Fi platform, as well as you can leave a tip or donation if you enjoy any of this free content that I put out for you guys and you think it's valuable. Now, let's move on back to some of the data. Charles Schwab net new assets fall on TD Ameritrade attrition. The stock is down. And Charles Schwab has had a decline in its core net new assets the past 2 months. This is pretty interesting. I'm not too sure why they're really losing so much money, especially after getting TD Ameritrade, you'd think that it basically is just suggesting that a lot of people are leaving Schwab after the TD acquisition. So I thought that that's pretty interesting to me. Now, what we have here is personal interest rate payments. All right, we talked about the government interest rates. It's at $506 billion, guys, and this is just in personal interest payments. These numbers do not include interest on mortgage payments. Americans are drowning in interest right now. And so RenMac right here, Renaissance Macro, they have basically their take on the VIX, and they use the volatility as a liquidity indicator. And it's amazing that we're testing multi-year lows this deep in the tightening cycle. Now we've started to see a rebound in the VIX, okay? But it really is crazy, guys. I mean, the VIX is just not really showing what the bears are showing, right? There's lots of FUD, there's lots of fear, uncertainty, doubt in the market right now. Especially surrounding a recession or some type of credit event and many different things, energy prices, and it's just not being reflected in the VIX necessarily. Now, what's interesting about this chart here is this is stocks that missed Q2 estimates, stocks that beat Q2 estimates, and then this is their earnings release date. So you can see that stocks that missed and beat both rallying ahead of earnings and then both dropping significantly. So it doesn't matter if they beat earnings or if they missed earnings. Basically, the result has been the same. And the reason for this, I believe, right, and my assumption is that everything just got a little bit too ahead of itself, right? Things were rallying so hard, into the summer, and now that we're basically having a little bit of a fall cool off, right? We're heading into fall now, if we're not already in fall, and we're just seeing things cool off, give back, right? I mean, you take a look at the earnings and they say, hey, well, maybe this company ran up a little bit too much. Even if they beat earnings, the stock probably just rallied a little bit too much ahead of earnings. And now earnings come out, the numbers come out, and it's time to look at their valuations and say, hey, well, even if this company is doing good and beating their estimates, we ran the price up a little bit too much. It's time to pull back. And obviously companies that missed are seeing the same sentiment and the same view as well in the market. Now, this is September market performance. And what we're seeing here, essentially the black dotted lines are the historical, and then the solid lines are basically the historical seasonality. And then we have what we're currently experiencing. And we've already started to decline after FOMC yesterday. So, could we see seasonality really start to kick in? And could the last half of September be pretty brutal? I think it's really interesting how the seasonality is lining up with the FOMC and how, the market is just starting to give things back. So will this become a self-fulfilling prophecy? And will, the market just continue to sell off for the rest of September? It's definitely something to consider and, pay close attention to. Now, you don't want to live or die by these seasonality charts, but it's just something that you can use as an inference point. All right, and we're actually going to head on over to TD Ameritrade now, okay, not to TD, to Thinkorswim, and take a look at some charts. So TLT, guys, I want to show you guys TLT right here at the moment. We talked about, basically, I think that TLT is going to end up staying in a range right now. I've been saying that we're trying to figure out where this range is, where it's going to be established, and we're breaking through the lows right here, right? If we were to go to a daily chart, you can see we're breaking through that 91.85 lows over here pre-market, and we're going to see how the reaction is today and coming soon. Now, believe it or not, I'm actually looking at trading TLT long, for a short-term swing trade. Just trying to figure out, where exactly I think support is going to be. But the reason behind this is because we're starting to build this bullish divergence, okay? And TLT tends to respect the technicals pretty well. So if we just take a look, we have some lows here. Let me make this yellow real quick for you so it's a little bit clearer. We have some lows here, we have some lows here, and we're making brand new lows. Now, on top of these lows, it appears that we are forming a little bit of a wedge. Or let me finish explaining the bullish divergence. So low, 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 lower lows, right? Three lower lows. We have low, we have low, we have higher low. So now we're actually making three higher lows on the 4-hour chart here for TLT. Meanwhile, the chart is making three lower lows. Now, on top of that, I mentioned, it does appear like we are trying to put in a little falling wedge right here. We've been rejecting the 50-day simple moving average here, basically right over here too. We couldn't get it. We couldn't really sustain above it. And then we have our 200-day moving average. So, if I do end up going long, I do think I'll be targeting this prior demand zone as an area of, potential supply zone now, sell side liquidity. And that should kind of coincide with the 50-day moving average coming down as well. It should also start to enter into this zone. And I know that'll be an area where there's lots of selling potentially, lots of resistance. Doesn't mean we can't break out of it, but I know here it was resistance, here it was resistance, sell side liquidity both times there. I want to show you guys something interesting. Okay, so if we were to come here to October and take a look at the open interest for the option chain, what do we see? Well, the highest strike, okay, the highest open interest on a strike, 40,000 is right here at the $90 puts, okay, and these expire October 20th. When you take a look at the call side liquidity, the bullish side liquidity, the highest is over here. Well, there's lots of high ones, but look at the price of these, right? These are $2 a piece right now. These are $10 a piece right now, and these are very, very far away. I mean, not extremely far away, but we're basically at 100 and 105. Where TLT is at right now, that's a pretty significant move that it would need to make within the next month, versus over here on the put side. Okay, we're seeing that this $90 strike price is only a couple dollars away. So, if the option market and if these put options are going to act a little bit as a magnet, it's very possible that TLT could come down to the $90 area before or by October 20th, 2023 expiration date. Okay. But when I look out a little bit further and go to January of 2024, right, we see that most of these are already in the money that have high open interest. We have 12,000 here at the $90 strike price. But when you come to the call side, right, we have 15,000 here at 95, 18,000 at 100, 23,000 at 105, 32,000 at 110. So there's lots of concentrated calls, basically within the 95 to about the 110 area. Okay. And these are some strikes that potentially I'll be looking at going at, right? They've got some time on them to help out a little bit with theta decay. And, to me, they're relatively inexpensive, anywhere from like $100 to, well, these are going to be even cheaper after market opens today because it's down so significantly. Yeah, so that's pretty much what I'm looking at on TLT, right? Looking at, signs of showing a potential bottom, looking at signs of showing a potential short-term bounce, okay? Not a full-on reversal, and it doesn't mean that we can't bounce just to continue going lower, potentially to that $90 price target. But at the end of the day, you guys want to, try to keep things simple. Okay, and there is a simple chart pattern here developing, not confirmed yet. We do have some bullish divergence here developing. We'll see if that plays out. It doesn't have to play out. Let's go ahead and move on to the dollar, right, and take a look at Dixie. So in the chart that I was going to show you guys, previously, we had the key levels. And so we were actually trading below 105.11, and we had 105.435 up here to the upside. And you can see that yesterday, that's actually where we closed. We closed right above that level. Today, we're opening above it. So watch the dollar today, okay? This 105.435 level is going to be very important. Is this going to turn into a classic, flip of resistance to support? Look to see if we retest there and if we continue to push higher. If we do, most likely that's going to be bearish for the stock market. Now, I've talked about within the last week, we were seeing some very strange things in the market, right? To be cautious of, right? And I was trying to warn people, basically what we were seeing was the dollar go up at the same time as we saw energy prices and oil prices go up, at the same time we saw treasury yields rise, and at the same time we saw the stock market rise. Those four things typically do not all move in the same direction. And obviously yesterday there was a huge rug pull, and we've seen a little bit of a reversal in some of the action. All right, sorry about that. I had to pause real quick. Market's going up and stuff, or market opening. But yeah, so look, we are currently seeing the S&P 500 drop, right? We talked initially about some bullish divergence, right, forming, and how really I was looking for yesterday to be a sell the news event, right? And so you can see lower lows here, started making higher lows on the RSI. I did go long in the market and sell, in the morning yesterday. And I knew that I really wasn't going to be trading, so I just wanted to take those profits. You see the S&P came right up to its resistance area here, and it's had a huge sell-off, breaking through the floor. We had lots of support in this area around 437 to 439, and we are completely breaking through that right now. So if we were to just simply zoom out a little bit, you can see right over here, prior support 435, basically breaking through that as well. So the S&P has started its move down, and it looks like we're heading towards 430. Okay, 429.21. There's going to be a little bit more support here around 431. So 429, 431 is definitely the next area that I see the market coming to. Okay, our last little line of defensive support before there on the S&P is going to be about 432.89. We're not very far away from there right now at the moment. So that's basically my quick update and take on the market. I've got another good video, really good video, lots of good charts and data coming soon. That one should be either out tonight or tomorrow in the morning around market open. So be sure to stay tuned for that one. Guys, don't forget to sign up for that free newsletter, okay? Completely free trade ideas, really good setups, also really good free valuable content, not just trade ideas, straight to your inbox, delivered straight to you.